In financial systems, thresholds are presented as fixed reference points. Capital ratios are defined in regulatory frameworks. Liquidity coverage ratios are calculated against standardized formulas. Margin requirements are published by clearinghouses. Collateral eligibility lists are detailed in legal agreements. Risk limits are embedded in internal dashboards. Credit caps are documented in policy manuals. On paper, these limits appear precise. They are expressed in percentages, basis points, multipliers, concentration limits, and exposure bands. They are displayed in quarterly reports and internal summaries. They are reviewed in committee meetings and referenced in compliance documentation. They suggest clarity, they imply stability. Yet the practical meaning of a threshold is shaped less by how it is written and more by how it is handled over time. A bank may maintain a target Tier 1 capital ratio within a clearly stated band. A treasury function may manage liquidity buffers relative to projected outflows under standardized stress scenarios. A trading desk may operate within value-at-risk constraints displayed in daily risk reports. A fund may maintain leverage within guidelines outlined in its prospectus. These numbers remain visible. They are monitored daily, recalculated as markets move, and compared against historical averages. They are incorporated into models and summarized in reports. They are rarely removed, but their significance evolves through repetition. At first, deviations from a stated liquidity buffer prompt review. A widening in credit spreads triggers recalibration of pricing assumptions. A modest increase in repo haircuts leads to updated funding projections. A margin increase requires adjustments in collateral allocation. The threshold is treated as firm, and the response is documented. As similar adjustments recur, the handling changes. A capital ratio drifting near an internal guidance level may no longer prompt formal escalation. A funding cost increase within a manageable range is incorporated into pricing models without reframing the broader environment. A margin requirement adjustment is processed through routine liquidity planning rather than reclassifying risk conditions. The numerical boundary remains intact. The procedural response becomes quieter. Risk dashboards continue to display leverage multiples, duration exposure, counterparty concentration, and liquidity metrics. Compliance systems continue to flag variance. Internal audit functions continue to review adherence to stated policies. Reporting structures remain in place. What shifts is the interpretation of those indicators. A metric that once signaled exception may begin to signal fluctuation. A spread that once implied imbalance may settle into an accepted corridor. A temporary accommodation, extended repeatedly, may begin to resemble baseline operation. The formal threshold remains unchanged. The effective boundary moves through usage. Clearing systems reflect this pattern. Variation margin continues to be calculated daily based on prevailing price movements. Initial margin models continue to update according to volatility inputs. Settlement cycles proceed on established timelines, yet modest increases in required collateral are absorbed into standard liquidity preparation rather than framed as stress events. The rulebook is not rewritten. The emphasis attached to its application softens. Collateral management functions similarly. Haircuts adjust within permissible ranges defined in agreements. Eligible asset lists are interpreted according to prevailing market pricing. Settlement delays are managed through established procedures. None of these adjustments necessarily require amendment to the underlying document. The agreement persists, the application adapts. Regulatory frameworks exhibit a comparable rhythm. Capital buffers remain specified in percentage terms. Liquidity metrics remain calculated against standardized assumptions. Stress testing exercises continue according to schedule. Disclosure requirements remain intact. But within those structures, institutions adapt incrementally to prevailing funding conditions, market depth, and price behavior. The documentation remains visible. The lived tolerance shifts. Funding markets often display this in gradual ways. Repo rates fluctuate within bands that slowly reset their center of gravity. Bid-ask spreads stabilize at new averages without formal reclassification. Credit facilities are renewed with slightly revised pricing grids. Covenants are measured relative to updated performance metrics. None of these adjustments are framed as decisive turning points. They appear as continuation within the same framework. Over time, participants internalize the adjusted range. Portfolio managers size positions according to current financing terms rather than prior volatility benchmarks. Treasury teams maintain liquidity buffers aligned with present clearing conditions. Risk officers evaluate exposures in the context of prevailing market depth rather than historical stress episodes. The categories remain unchanged: capital, liquidity, leverage, duration, exposure. The space considered usable within those categories evolves. This shift does not require announcement. Capital ratio targets remain cited in investor presentations. Leverage guidelines remain printed in internal manuals. Margin schedules remain posted by exchanges. Liquidity buffers remain disclosed in filings. Stress test scenarios remain described in reports. What changes is the distance from the threshold at which action feels necessary. In earlier phases, proximity to a limit may have prompted immediate review. Over time, similar proximity may prompt monitoring rather than escalation. The threshold continues to exist as a reference. The interpretation of its urgency adjusts. In this phase, continuity becomes the organizing principle. As long as trades settle, collateral clears, funding renews, and balance sheets reconcile, minor deviations are incorporated into routine oversight. The objective is not to restore prior calibration, but to operate within manageable bounds. The threshold remains defined. Its operational meaning evolves through use. Each accommodation appears minor in isolation. A few basis points in funding costs, a slightly wider bid-ask spread, a modest adjustment to collateral valuation, an extended review timeline. Taken together over months and quarters, these incremental changes redefine the effective perimeter without requiring formal revision. No single committee meeting declares a new boundary. No regulatory filing announces a recalibrated standard. Instead, the functional range shifts through accumulated practice. Reports continue to display the same headings. Ratios continue to be calculated. Metrics continue to be cited. The numbers persist. Their practical interpretation settles into a new rhythm. This produces an environment that feels stable without being identical to prior conditions. Activity continues at a steady pace. Capital circulates. Positions roll forward. Funding arrangements renew. Risk metrics fluctuate within accepted corridors. Nothing appears to break. Nothing appears to resolve. The framework remains intact. The space within it is handled differently than before. Over time, the distinction between original calibration and current operation becomes less pronounced. Participants no longer reference the earlier range as a benchmark for correction. They reference the present range as the working baseline. The threshold remains measured. It is still displayed in dashboards and filings. It is still discussed in reviews. Its practical boundary has adjusted through repetition. This process is gradual enough to avoid classification. It does not register as reform or reversal. It does not require narrative emphasis. It emerges through continued application of existing procedures to slightly altered conditions. As repetition accumulates, the adjusted tolerance feels ordinary. What once required explicit justification becomes standard notation. What once prompted formal escalation becomes an item within routine reporting. The threshold is still there. It is still cited. Its handling has changed quietly enough to become familiar. There is no moment of redefinition. No formal announcement marks the transition from one boundary to another. The ratios remain printed, the margins remain posted, the spreads remain quoted, the buffers remain disclosed. Within those references, daily activity proceeds. The system does not remove its limits, it inhabits them differently. Over time, that difference loses its distinctness. The operational meaning of the threshold adapts without altering its documented form. The boundary remains in place. Its practical perimeter shifts through use, and eventually that shift stops drawing attention.